Welcome to the Byte-Size Brief. Today we are putting Booz Allen Hamilton HLDG Corp. BAH, that's BAH, completely under the microscope. Let's get into it.
Yeah, it is great to be here. Taking a deep dive into this company's transition right now, well, it reveals just this totally fascinating moment in defense tech.
It really is. I mean, imagine a fleet of robotic submarines or, swarms of autonomous drones and AI fighting cyber wars in real time.
Right, sounds exactly like a sci-fi movie.
Exactly. It's actually the new business model of a 70-year-old company that you probably thought just sold government white papers and consulting hours.
Yeah, that legacy image is definitely hard to shake.
For you listening, our mission today is pretty straightforward, but the answer is incredibly complex. We are looking at this massive government contractor, and we need to determine what it actually is today.
Right, like, is this company just a legacy dinosaur surviving on old consulting habits, or is it fundamentally transforming into a cutting-edge defense tech powerhouse?
That is the ultimate question for anyone looking at this stock.
And to ground us in the current reality, let's look at the market data right now. Currently, Booz Allen Hamilton HLDG Corp. BAH has been trading in a fairly wide range, roughly between $76 and $102 per share.
Okay, that's a pretty wide spread.
It is. And that puts their market capitalization somewhere in the neighborhood of $9.6 billion to $12.3 billion.
Right.
But what is really crucial to understand for anyone evaluating the stock is that this current valuation follows a recent, very noticeable pullback.
Yeah, and that pullback isn't happening in a vacuum. I mean, it is directly tied to what I would call a fundamental identity crisis that is driving a lot of recent volatility.
Definitely.
Let's shed some light on the scary headlines that have been spooking retail investors lately.
Yeah, the headlines haven't been pretty.
The Pentagon recently went through and ruthlessly canceled 234 consulting contracts.
Wow, yeah.
And out of those, Booz Allen Hamilton HLDG Corp. BAH lost 97 of them. That is a huge chunk of business just vaporized overnight.
It really is a significant hit.
And if that wasn't enough to make you sweat, the Treasury Department just canceled all of their contracts with the company.
Right, which were worth $21 million in total obligations.
Exactly, all because of a taxpayer info leak. When you read that as an investor, your immediate reaction is to just hit the panic button and run for the hills.
I mean, it certainly sounds alarming on the surface. A loss of nearly 100 defense contracts is never going to generate positive headlines.
No, definitely not.
But when you dig into the underlying strategy, you have to kind of reframe what these cancellations actually represent. Let's look at what Andrea and Sarah, the head of their global defense business, recently stated.
Okay, what did she say?
According to her, traditional consulting now makes up only 1% of their overall business.
Wait, seriously? Just 1%?
Just 1%. They are actively and intentionally stepping away from that legacy model.
Huh. So it's not just a minor shift.
Not at all. For example, they are divesting parts of their DARPA business.
DARPA. Remind everyone what that is again.
Sure. So DARPA is the Defense Advanced Research Projects Agency. It's the Pentagon's top-secret R&D arm that famously invented the foundations of the modern internet.
Oh, right. So they're just walking away from that.
Yeah, giving up DARPA revenue hurts in the short term, but they are doing it specifically so they can focus on high-value, high-tech opportunities rather than just advisory roles.
So basically, it's kind of like shedding the old suit-and-tie consultant skin to become a hardcore tech developer.
Exactly. The entire defense ecosystem is currently undergoing this massive structural pivot.
Okay, so the whole industry is shifting.
Yes, the Department of Defense is moving aggressively away from traditional IT services and hourly consulting. They want tangible technological solutions that can be deployed immediately at the tactical edge.
Right, but what does all of that actually mean for Booz Allen Hamilton, HLDG Corp. BAH investors?
Well, it means a painful but necessary transition to higher margin, outcome-based contracts. Under the old model, they billed the government for hours spent trying to solve a problem. Now they are getting paid for the outcome.
Got it. Do we have a real-world example of that?
A perfect example of this in action is the Thunderdome Cybersecurity program.
Thunderdome. Sounds intense.
It is. It's a fixed-price, outcome-based contract focused on deploying zero-trust architecture across government networks.
Zero-trust architecture is a term that gets thrown around a lot in tech circles. For our listeners who might not be deep into cybersecurity, how does that actually work?
Think of traditional cybersecurity like a medieval castle with a moat. Once you get past the drawbridge and you are inside the castle walls, you can pretty much go anywhere and do anything.
Right, which is obviously a huge security flaw if someone sneaks in.
Exactly. Zero trust architecture operates on the principle of never trust, always verify.
Okay, so like needing a key card for every single room.
Precisely. It is like a high-security facility where every single elevator and hallway requires a new biometric check, even if you are already inside the building.
And they're trying to build that for the entire Department of Defense.
Yes, and implementing that is incredibly complex. But because Thunderdome is a fixed-price contract, if Booz Allen Hamilton HLDG Corp. BAH can deploy that architecture efficiently using their own proprietary tech, they capture a much higher profit margin.
Oh, I see. So the efficiency actually pays off for them directly.
Exactly. It gives them the flexibility to innovate. But more importantly, it locks in long-term profitability that the old hourly billing model simply couldn't support.
Okay, so if they are moving away from just giving advice and moving into hardcore tech like zero trust, we have to talk about how they are actually acquiring that tech.
Right, because they aren't just building it all in-house from scratch.
Yeah, they're basically acting like a Silicon Valley player now, aggressively deploying venture capital.
That is a critical piece of their new identity. They have established the Booz Allen Ventures Fund, which now has $300 million in capital to deploy.
$300 million is no joke.
No, it's not. And they aren't just throwing money at the wall hoping something sticks. They formed a strategic partnership with Andreessen Horowitz, commonly known as A16s.
Oh, wow. So they're teaming up with one of the most powerful and connected venture capital firms in the world.
Precisely. This gives them direct, early access to emerging commercial technologies that they can adapt for military use.
And the companies they are investing in are mind-blowing. Let's run through this portfolio because it really does highlight the shift we are talking about.
Let's do it.
First, they invested in PDW. This is a drone company that has the capacity to produce 100,000 defense drones a year.
100,000. We're talking about mass production, not artisanal defense manufacturing.
Exactly. Then you have Shield AI. They make an AI-powered software called HiveMind.
HiveMind is particularly fascinating because of how it alters the mechanics of warfare.
How so?
It essentially gives autonomous military aircraft a shared intelligence.
Right. So it's not just a guy with a joystick flying a drone remotely from a trailer in Nevada.
Exactly. It's an actual swarm. If one drone in the swarm spots a radar installation, the entire swarm instantly knows it is there without a human having to type in the coordinates.
Wow.
It operates autonomously even if communication signals are jammed by an adversary. And they haven't stopped at the sky.
Right. They also put money into Ulysses, which focuses on maritime autonomy.
Yeah, think robotic submarines and surface vessels that can map the ocean floor or detect underwater anomalies without risking human divers.
And if land, air, and sea weren't enough, they invested in Portal Space Systems to develop orbital warfare capabilities.
Essentially ensuring that satellite networks, which are crucial for global communication, remain secure from tampering.
The sheer breadth of those investments illustrates exactly where the Department of Defense is heading.
We are talking about highly scalable autonomous systems across every single operational domain space, sea, air, and cyber.
Hold on. How does that actually affect Booz Allen Hamilton HLDG Corp. HH's stock price for regular investors like me?
That's a fair question.
Like, are they just an index fund for defense startups now? Why wouldn't I just try to invest in defense tech directly?
It is easy to view them that way, but the answer lies in what CDO Horatio Rosansky calls their co-creation strategy.
Co-creation, what does that actually look like in practice?
Well, Rosansky has made it very clear that the United States has to be, in his words, faster than China.
Right. The geopolitical pressure is huge.
The grim reality is that the U.S. government procurement process moves entirely too slowly to invent and deploy all this tech on its own.
So Booz Allen Hamilton HLDG Corp. BAH acts as the crucial bridge.
Yes. They aren't just holding equity in these startups like a passive mutual fund.
They are taking this raw commercial technology, integrating their own proprietary cyber and defense intellectual property into it, and productizing it.
Exactly, to meet the rigorous standards of the Pentagon.
So they are basically the ultimate translators. They take a Silicon Valley invention that might be brilliant but lacks security clearances, and they turn it into something the military can actually plug into their networks without getting hacked.
Precisely. Let's look at their product, Velox Reverser, as an example.
Okay, what does that do?
Normally, if a government network gets hit with new unidentified malware, a human cyber analyst has to spend days or even weeks picking apart the virus code to understand what it does.
Which is way too slow in a cyber war.
Exactly. Velox Reverser uses artificial intelligence to reverse engineer the malware's intent in seconds.
Oh, wow. So it acts essentially as a digital immune system.
That's a great way to put it. Or consider how they are currently deploying 5G networks directly onto Navy ships.
Which sounds simple, but I imagine it changes everything about how a ship operates.
It turns a ship into a floating-edge computing data center. Historically, ships had to beam data back to a server on land, which creates latency.
And that's a massive problem if you are trying to target an incoming missile.
Exactly. By deploying 5G and AI directly on the ship, decisions can be made locally in milliseconds.
That is incredible.
By doing this kind of integration, Booz Allen Hamilton HLDG Corp. BAH is productizing its intellectual property.
Which makes the government totally dependent on them.
Right. That creates incredibly sticky long-term revenue streams because the government becomes structurally dependent on their specific integrated systems, not just their consulting advice.
Okay, so compared to last quarter, what actually moved the needle here? Because all these drone armies and AI platforms sound great, but if it doesn't show up in the earnings report, it is just expensive window dressing.
The latest quarter presents a very nuanced picture of a company right in the middle of a major transformation.
Let's start with the good news.
Let's start with the improvements, which are substantial. They delivered a massive profitability beat.
Okay, how massive are we talking?
Adjusted earnings per share came in at $1.77. The market was only expecting $1.27.
Wow, a nearly 40% beat on the bottom line.
Yes, a staggering 39.3% beat. And their forward-looking metrics provide a lot of security.
You're talking about the backlog.
Exactly. Their backlog, which is the contracted work they have won but haven't billed for yet, is up 15.3% year over year.
That is huge.
It just hit a massive $37 billion.
$37 billion. That acts as an incredible safety net.
It really does, and it's largely fueled by double-digit growth in their national security pipeline.
What about the guidance for the rest of the year?
Furthermore, their full-year revenue guidance is holding strong at $11.35 billion, with adjusted EBITDA guidance at $1.21 billion.
For those who might not track EBITDA closely, that essentially measures the pure cash flow from their core operations before accounting rules get factored in.
Spot on. And importantly for liquidity, they generated an impressive $911 million in free cash flow.
So that's the good news. What's the bad news?
Well, there's a top-line struggle. Q4 calendar year sales fell 10.2% year over year to $2.62 billion.
And that missed analyst estimates.
It did. And their operating margins dipped from 10% to 8.8%.
Wait, so revenue is shrinking by 10%, but profits are up 40%? I'm looking at this math and it feels like a magic trick.
It does seem counterintuitive.
Are they just firing people to inflate the bottom line, or is there a real strategy here?
It is definitely a valid concern, but it comes down to extremely aggressive operational discipline rather than just a slash-and-burn headcount reduction.
How so?
The margin strength we saw on the bottom line, despite the revenue decline, was entirely driven by swift cost reduction measures enacted early in the quarter.
So they saw the revenue drop coming.
Management knew the top-line environment was going to be tough.
Yeah.
They were facing government funding delays and the cancellation of those legacy consulting contracts we discussed earlier.
Right, the 97 canceled contract.
Exactly. By aggressively cutting overhead and shedding lower-margin legacy business lines, they successfully defended their profitability.
So they just trimmed the fat.
Management describes this as a reset. They are establishing a leaner, more efficient cost base now.
I see.
This setup will allow for significant margin expansion in the future as those high-margin, outcome-based tech contracts like Thunderdome fully come online and scale.
That makes total sense. They're taking the pain now, cleaning house, to set up the gains later.
Exactly.
So having seen this massive earnings beat sitting right next to a top-line revenue decline, we really need to do a financial reality check.
Definitely. It's crucial for investors.
Is this stock a safe harbor with a massive moat? Or is it the value trap? I'll start with the bull case because the valuation here is honestly making me excited.
Let's hear it.
Right now, Booz Allen Hamilton HLDG Corp. BAH is trading at a forward price-to-earnings ratio of around 11.3 to 11.58.
That is quite low for the sector.
Exactly. If you compare that to competitors in the space like CCI, you're basically shopping in the discount aisle for a premium defense contractor.
The valuation is certainly compelling when you look at it strictly on a comparative basis.
And if you look at a discounted cash flow model, it suggests the stock is currently 50% undervalued. You are practically buying this company at half price relative to its future cash generation.
That is a very strong argument for the bulls.
Plus, while you wait for the broader market to wake up and see the tech pivot, you're getting paid a solid 2.82% dividend yield.
Which works out to 59 cents per share.
Right. And the company clearly believes in itself because they just executed $764 million in share repurchases.
That is a massive vote of confidence from management.
On top of all that, you have massive institutional trust. Vanguard alone owns over 5.22% of the company. Vanguard doesn't just throw that kind of money around unless they see deep, long-term stability.
Those are strong, data-backed points for the bulls, but we have to cool the room down and look at the structural risks.
Okay, lay the bear case on me.
The bear case here is rooted in their balance sheet and the volatile nature of their ultimate customer. First, the leverage is a serious concern. Yes, they have a high debt-to-equity ratio of 4.04 times.
Ouch.
And their net leverage ratio sits at 2.4 times.
To put that in perspective for everyone, a 2.4 net leverage ratio means that even if they used every single penny of their core profit to pay off debt, it would still take them almost 2.5 years to clear the balance.
Exactly. That is definitely heavy. Carrying that much debt limits your maneuverability.
It really does.
And when you carry that much debt, you need constant, predictable cash flow to service it. This makes the company highly vulnerable to macro-political events.
Like a government shutdown.
Precisely. A sudden federal budget cut or a prolonged government shutdown due to gridlock in Congress could severely disrupt their cash generation while those massive debt obligations remain firmly fixed.
That is a terrifying thought for shareholders.
Furthermore, we are seeing an 8.11% short interest in the stock.
With nearly 6.42 days to cover. For the retail folks, days to cover means it would take short sellers roughly 6.5 days of normal trading volume to buy back all the shares they bet against.
That is a lot of sustained downward pressure.
So there's a lot of active betting against them.
It is not an insignificant amount of pessimism. It indicates that a meaningful portion of the market is actively getting against their ability to maintain these lucrative tech contracts in a shifting, unpredictable political environment.
So it's like buying a high-performance sports car at a discount. But you have to accept that the government holds the keys to the gas station.
That is a highly accurate way to visualize the risk profile. The technology they are building and integrating is undeniable, but their entire operational destiny is inherently tethered to Washington.
And if Capitol Hill decides to freeze spending, you're stuck holding a very expensive bag.
Exactly. If we connect this to the bigger picture, it raises a profound question about timeline and execution.
What kind of timeline are we looking at?
Horacio Rosansky pointed out that autonomous AI agents are projected to become active cyber threats by the year 2026.
It is right now?
That is right now. The bad guys are literally using AI to attack our infrastructure today. It's not a future problem, it's a current reality.
It really is.
So the final provocative thought I want to leave you with is this. Will Booz Allen Hamilton HLDG Corp. BAH's aggressive investments in commercial AI and venture capital be enough and be integrated fast enough to actively defend national infrastructure?
Or will the legacy baggage slow them down?
Exactly. Will the heavy baggage of their legacy consulting history, combined with a highly leveraged balance sheet, slow them down in a race where second place simply isn't an option?
That is the ultimate question right there. It is a race against time, technology, and government bureaucracy. All right, listeners, what's your take on the future of Booz Allen Hamilton HLDG Corp. BAH? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.